You know, we all feel inflation when we're at the grocery store or filling up the car. But what if I told you there was an early warning signal, a way to get a sneak peek at where those prices are headed next? Well, there is, and it's called the Producer Price Index.
And guess what? The latest numbers for September just dropped. And this is one of those reports that economists and market watchers, well, they really pore over this stuff to figure out what's actually going on with the economy.
Because after things seem to cool down for a minute, this signal is flashing hot again. The prices that businesses are charging each other are climbing, and that has huge implications for every single one of us. So let's pull back the curtain and see what's really driving these numbers.
All right, first things first. Let's make sure we're all on the same page. What is this thing, the Producer Price Index, and why do people call it inflation's early warning system?
Just think about it like this. Before, say, a new phone gets to the store, a ton of things have to happen, right? The parts are made, it's assembled, it's shipped. And every one of those steps involves businesses selling stuff to other businesses. And that's exactly where the PPI comes into play.
The Producer Price Index, or PPI for short, basically tracks the average change in all those selling prices between businesses. You can think of it as wholesale inflation. And it makes sense, right? If it costs more for producers to make and ship things, there's a pretty good chance that extra cost is eventually going to get passed on to you. And here it is. This is the headline number that's got everybody talking. Producer prices went up by 0.31% in September. Now, I know what you're thinking. That doesn't exactly sound like a huge number, but in economics, it's all about the trend. And here's why that little number is a big deal. If you imagine that same increase happening every single month for a year, what economists call annualizing it, suddenly you're looking at a pretty hot 3.8% inflation rate. And this is a huge reversal from August, when prices actually went down. The trend just did a complete U-turn.
So let's pop the hood. What exactly is lurking inside this number that's causing such a big bounce? Let's unpack it. You see, that main PPI number is really just an average of a whole bunch of different things. And when you start to break it down, you find that a couple of very, very volatile items are doing all the heavy lifting here. First, get a load of this. Energy prices for producers, they absolutely exploded in September. That 1-month jump works out to a mind-boggling 51% annualized rate. I mean, just think about that. A massive spike that jacks up the cost of making and shipping, well, pretty much everything. And right on the heels of energy, you've got food prices. They also jumped in a big way, rising at a 14% annualized pace. So you've got these two absolute essentials just surging at the same time. Okay, now this is where the story gets really interesting. Look at this split. On the left, you see those wild, crazy swings from food and energy. But if you pull those out and just look at what's left, what economists call core goods, the picture is way calmer. It's rising at a much more manageable 2.1% annualized rate. And that, right there, is exactly why you always hear the experts talking about core inflation. By stripping out the stuff that jumps all over the place, they're trying to get a much clearer read on the real underlying persistent inflation trend in the economy. Now, goods are just one side of the coin. The services part of the economy was, well, it was more of a mixed bag. You can see trade services actually dipped a little bit. But the real story, the number that just jumps off the page here, is that one right on top. Yeah, transportation and warehousing costs shot up 0.8% in just 1 month. That's a 10% annualized rate. So the cost of just moving stuff around the country is getting a lot more expensive. And that's a cost that hits basically every single business that sells a physical product. Okay, so that was the deep dive into September. But you know, 1 month can always be a blip. So let's zoom out a little and see how this all fits into the bigger story we've been watching unfold this year. This timeline really tells the tale. After hitting rock bottom back in June, the PPI has been picking up speed in what the source article calls a zigzagging manner. We saw that little dip in August, but this big bounce in September puts us right back on that upward path. And if we look at the year-over-year numbers, that upward trend is even clearer. But here's the real kicker. Notice how the numbers for both July and August were revised upward. That means inflation at the producer level was already running hotter than we first thought. The pressure has been building for a while. So this brings us to the most important part of the whole thing. We've dug into the numbers, but how does all this actually connect the dots back to your wallet? And look, it's a totally fair question. This all sounds like a bunch of business-to-business stuff that happens way up in the supply chain. So why should you, as a consumer, even care about the Producer Price Index? Here's why.
Think of it as your personal economic sneak peek. For one, it's a huge leading indicator for the prices that you end up paying. It also tells us if businesses are just absorbing these higher costs or if they're getting ready to pass them on down the line to you. It's this constant tug of war. And this quote from the Wall Street article just nails that tug of war idea. It's talking about tariffs, which are basically just taxes on imported stuff. And you can see the friction here. The suppliers' costs go up, but they can't just easily raise their prices because they know companies, and ultimately you, will push back. The PPI is our window into who's winning that fight. So the bottom line is this. After a bit of a pause, the cost of doing business is going up again. This reacceleration in producer prices is building up a pipeline of inflationary pressure that could very well spill over into the prices we all pay in the coming months.
And all this leaves us with a fascinating puzzle. On the one hand, you have inflationary signals like the PPI heating up, which suggests the Federal Reserve needs to stay on its toes. But at the exact same time, you have big parts of the market that are still hoping for interest rate cuts. Both of those things can't be right. So what gives? It's really the central economic question we're all facing right now.